Right, I'm going to try and take your minds off your rumbling stomachs for the next 15 minutes or so by trying to tackle an exam question. And the exam question that I've set myself is, how high might default rates rise in the SME sector when the next recession happens? It's a question that Funding Circle have already tried to answer by undertaking some stress testing on their own portfolio, and that's come back with an answer of around 1.55 times. So what I'm going to try and do is just a bit of a sniff test on this. Does it feel right? Does that feel reasonable and realistic to expect? Especially in light of the fact that the US corporate default rate rose by a factor of nearly 3 times in the last recession. Zopa's experience of insolvencies in the consumer space rose by 10 times in the last recession. So does this 1.55 times that Funding Circle are coming out with, does that feel reasonable? Well, my first exhibit is nothing to do with US default rates or consumer default rates. This is UK business default rates or business insolvency rates over the last 5 decades, the last 50 years. When I look at this chart, I always think of that old surfing mythology, you know, the one that says the 7th wave is always the biggest. We've got a few more decades to wait to see whether the same holds true of UK recessions. But what we can do already is to divide it up into 5 decades. Assume each decade is roughly one economic cycle, and we can calculate the average insolvency rate throughout the cycle and compare that to the peak in the recession. So taking the 1990s recession as an example, we find that that peak to average ratio is 1.55 times. Exactly the same as what Funding Circle calculated. And in fact, over the whole period, we see that each recession has a remarkably consistent ratio, about 1.5 times. Every recession, insolvency rates rise by around 50%, except for the most recent recession. In 2008-2009, the peak was only 25% higher than was experienced throughout the rest of the noughties. And you may think, well, yeah, but surely that varies massively by region. What about the north-south divide and the two-speed economy, and by industry sector? Well, actually, no. The blue bars here show this peak-to-average ratio by region in the most recent recession. The red bars are the 1990-91 recession. Remarkably little variation. Really very even-handed. By industry sector, there is one very obvious standout sector, property, in the 1990s. If you had too much concentration in the property sector in the early 1990s recession, as Barclays did, those of you that can remember that, you would have suffered some pretty painful losses. But what also stands out is just how even-handed the more recent recession was. There's really little variation across those blue bars. Very even-handed recession, or was it? If we look at it by size of business, it wasn't so even-handed. The red line are true SMEs, 6 to 100 employee businesses. Really, you could say the core target market for alternative finance. And they were the worst affected, seeing a 40% rise in insolvency rates. The other story here is the blue line, micro businesses, less than 5 employees. They have the lowest insolvency rates overall, but even more interestingly, they were barely affected by the recession. Insolvency rates only rose by about 10%. And that sounds a bit worrying. So what we're saying here is that the worst recession, or the most painful financial crisis since the Great Depression, was actually only half a recession compared to previous recessions. And moreover, it was a recession that left micro businesses virtually unscathed. I mean, what's going on here? Are we waiting? Is there going to be the second half of this recession coming anytime soon? Well, I don't think so. And here's the reason. First, let me rescale the axis so that I can put on another line. The dissolution rate, benign closures, businesses just winding up. You don't have to look too hard to see where the main story is here. In 2009, 20% of limited UK businesses ceased trading. Over 500,000 firms that were there in 2008 were not there by the end of 2009. And you may think, well, yeah, but dissolutions, they're benign closures. No bad debt involved. Someone's just decided to wind up the business and disappear. And in a lot of cases, that's true, but we don't think that's always the case, because if you look at the latest balance sheets of this population of dissolutions, what we find is that a significant minority have liabilities greater than their assets. Yeah, they are technically insolvent. They have negative shareholders' funds, often very small amounts. And our supposition is that often creditors won't bother putting them through insolvency proceedings because the amounts aren't that much and there are no assets anyway, so they're not going to get their money back. But these are still technically insolvencies. We call them the hidden insolvency population. And if we add these hidden insolvencies to the official insolvency rate, what we get to is a figure of about 1.49, a multiple of about 1.49 times. In other words, this recession actually was very much in line with all of the previous recessions, which I guess is kind of reassuring. Even more reassuring because what we find, of course, is that these hidden insolvencies tend to affect micro businesses. So our blue line, which was down here at around 1% and seeing barely an uptick in the recession, now sits much more in line with the rest of the SME population. So that's reassuring. Also reassuring is the fact that the level we get to now overall is around 2 to 2.5% across the cycle, rising to about 3.5% in the recession. Very much, again, in line with Funding Circle's figures. So this is a kind of a reassuring picture, but it still begs the question, what was going on? What happened? Why did this recession pan out so differently in terms of the way businesses went out of business to all previous recessions? And the answer is actually quite simple. The composition of the business universe has changed. It's manifestly changed. Firstly, it's just grown. There are 3 times as many businesses out there today, and indeed there were in 2008, compared to the start of the 1990s recession. 3 times as many. The business population had been growing steadily for 25 years and has then grown explosively for the next 25 years. And this growth is not by any means equal across all industry sectors. If we split the economy into two very broad industry sectors, goods-producing firms at the bottom, the blue wave, and service sectors in the green area. Manufacturers, construction firms, wholesale and retail have grown incrementally over the period. The explosion has come from the service sector. This chart maybe doesn't do it justice. Let me illustrate it another way. In 1990, 60% of the business population were goods producers or sellers of goods. By the mid-noughties, it had completely flipped. 60% of the population are service sector firms, and that's continued to be the case. If we zoom in a bit more detail on some of those sectors, the biggest growth sectors tend to be things like human health and physical well-being activities, internet-based retail, hardware, software consultancy, in other words, website design and search engines and so on. All of these are sectors that are fundamentally knowledge-based, skills-based. You don't need huge amounts of tangible fixed assets. Often they can be run from people's own homes. All the assets are what resides in the heads of the owners, the knowledge and the skills that they have. The sectors that have been declining are your classical traditional sectors, printing, mechanical engineering, heavy-duty manufacturing. So we're very much moving away from an economy where physical, tangible assets are required to run businesses, and that's what's enabled this enormous growth. And of course, what that then leads to is the reality that the growth has come not from traditional businesses with hundreds of thousands of pounds of assets that they need to fund and need to borrow in order to fund, but from micro businesses with minimal levels of fixed assets. And you may say, well, yeah, of course, in that case, these businesses are not likely to be borrowing. And indeed, they're not. The population, or the size of the population that has been borrowing, is remarkably consistent over the last 25 years. The explosion in the growth has come from non-borrowing businesses. And that then begs the question, well, surely if businesses are not borrowing, how can they go insolvent? If they're not borrowing, there's nothing for them to go insolvent on. So should our analysis not be focused purely on this green population, the borrowing population, rather than on the entire universe? So let's do that. And in fact, let's go the whole hog. Let's focus on the borrowing population of core alternative finance businesses, 6 to 100 employee businesses, and include the hidden insolvencies. We still get to a figure of around 1.5 times. In other words, with all of the things that we can throw at it, all of the sniff tests that we can apply, we still come to the conclusion that in a recession, our best estimate, and of course this is forward-looking, I don't actually have a crystal ball, but our best estimate is that Funding Circle's figure of around a 1.5-fold increase in default rates is entirely reasonable. There is a but. There had to be a but. All of this analysis has been based on the entire business population, all mixes of credit quality, from A-rated firms over there on the left as you're looking at it, with a very low insolvency rate, all the way across to E-rated firms with a very high insolvency rate. roughly normal distribution. As we've been hearing from several of our speakers earlier, the reality is that most of the platforms, most of the providers in this space have been fairly risk averse, understandably so in the early days. So you can imagine that the typical portfolio might look more like this. I should stress this is entirely hypothetical. This is not any actual real portfolio. But my guess would be that you wouldn't have very many A-rated firms because they tend to be self-funding or able to access funds at very good prices from wherever they choose. But you'd have stayed away from D and E-rated firms by and large. So you'd have a preponderance of the average to slightly above average credit quality businesses. Also, as we've been hearing, the reality is that mix is likely to change over time. Risk appetite is going to increase. So again, this is purely hypothetical, but one could imagine a scenario where our current blue portfolio starts to shift towards a weaker mix of credit qualities, not a bad mix, but a slightly weaker mix of credit qualities, taking on board a few more D-rated firms. And of course, as you start to take on board the below average, some of those will migrate to the really risky end of the scale. And of course, the danger is that if this migration happens too quickly, if it happens in an uncontrolled way, and then you get hit by the double whammy of a recession, that's when you could start to see default rates and bad debt rates rising up to levels. I've got a notional level here of 1.75 times. That figure could be almost anything, depending on the extent to which your portfolio has migrated towards the weaker end of the scale. So this really begs two questions. One is, and excuse this is my only plug for Experian services, but it really does stress the importance of monitoring your portfolio over time and controlling this migration as you increase your risk appetite. But the second, I guess, point is it begs the question about should there be a bad debt fund? Should businesses put in place, should lenders or providers put in place bad debt funds? And if so, should those bad debt funds be enough to cover even this worst case scenario, this double whammy of a worsening portfolio and then a recession? I don't have any real data that talks to this point, but I would just like to raise a quick concern here, which is that if you create a bad debt fund, which is enough to convince investors that the industry is risk-free, that even in the worst case scenario, they will still get their money back, what's going to happen is money is going to come flooding into the market. As money comes flooding into the market, that's going to start to drive loan rates down. That's going to increase the interest from borrowers. If this is happening when market awareness is already increasing, and simultaneously, as we've said, risk appetite is increasing, then you could end up with a scenario where an awful lot of money is going out to below prime or non-prime borrowers. And you end up with a situation a bit too similar to 2007 for my liking. But of course, in this case, it wouldn't be the banks who are in the firing line, it would be this industry. I don't want to end on a real down note, so let me finish by just explaining to you why I'm really excited by everything that's going on in this industry. As we've seen, the business population is going through an enormous change. It is manifestly turning on its head in terms of the nature of businesses out there. And in a way, I think that the banks, and this is not bank bashing, but the banks are not geared up to cope with. They are geared up to cope with businesses requiring substantial volumes of borrowing that they can largely predict well in advance, so they can take their time to do the due diligence that they need to do, and then lend against collateral, against assets that the business has. As we've seen, businesses these days don't have any assets, so that goes out of the window. What they have is working capital needs. Your typical, and this comes from an awful lot of surveys, your typical small business, their main concerns are getting paid by their suppliers, by their customers quickly. Well, that's a tough ask. The average UK business pays its invoices around 20 to 25 days late. And the more you grow and the more you deal with larger businesses, the later you're going to get paid. And in ordinary times or in years gone by, the way you might have dealt with this would have been by getting an overdraft from your bank to cover the temporary shortfall in cash flow. But Basel capital requirements have meant that banks are reining in on overdrafts. It's just not an efficient way for them to be lending. So you've got this scenario where an awful lot of businesses, a growing population of businesses that maybe don't have needs to fund physical, tangible assets or to fund enormous growth, but where they are struggling to get the cash through and will have a real need for funding, for working capital. So if I go back to my, my chart of the growth of the business population, the green swathe at the bottom are those that are served by current traditional lenders. The red population are the 15% E-rated firms that are almost proactively not served. They shouldn't be served. They're too high risk. The yellow population is that the SME finance monitor calls permanent non-borrowers. But then the purple wave at the top, and it's a big wave and a growing wave, are what I would say is the real potential for the alternative finance market. And it's about 1 million businesses. At the moment, you're probably serving maybe 10,000. So it's a massive, massive opportunity. So let me just sum all of that. The headline is the stress test passes the Sniff test. It's passed everything that we can throw at it. So we would say that the funding circle figure of a 1.55-fold increase is entirely reasonable. There is a but. It's that, of course, if you migrate to a worse credit or mix of credit qualities, that ratio could be significantly higher. But there is the happy ending. To go back to my surfing analogy at the beginning, there is this huge wave of opportunity, and it's you guys that are surfing this wave. Traditional lenders are either paddling furiously to try and catch the wave, or they're still sat on their deck chairs on the beach going, looks a bit risky to me. You guys are surfing it. So it is really exciting, but just take on board the morals of the story. It is critical to continue to measure and monitor the risk. It's not a zero-risk sport, and if you try and convince yourselves or your investors that it is a zero-risk sport, then that's when someone is likely to wipe out. Thank you.